All right. Hi, everybody. My name is Brandon Jenkins. I am a co-founder of a site called Popularise, but also a company called Fundrise that I wanted to talk to you guys about today. And what Fundrise is a bottom-up direct investment platform. But really the big idea is one about crowdfunding and how we think basically a new form of public ownership is going to really change the way cities get built. And I think the previous panel was actually a very interesting segue into what I want to talk about. I think you heard a lot of the people up here talking about how the development model as it exists today is one that doesn't always focus on design or what may necessarily be in the best interest of the community. And it's also one that doesn't always focus on long-term thinking. So I think the easiest way to kind of describe what it is we're trying to do is to tell you a little bit about our story. Myself and my colleagues, we were retail developers in Washington, D.C. So we used to build projects in downtown D.C., and we had a lot of partners, financial partners from places like New York City. This picture is actually a picture of 8th Street Northeast, which, to describe it as short as possible, is kind of like our version in DC of Brooklyn. It's a place where you have a lot of young people moving. It's an area where there hadn't been a lot of development for about 50 or 60 years. But in the last 5 or 10 years, it's really become a very hot area with a lot of growth. And coming out of the last recession, we thought a lot about kind of what were the trends that we were seeing and where we saw great development opportunities in places like 8th Street, these emerging neighborhoods, were areas where we really thought there was great opportunity. And what we found was that all of our financial partners who had previously done deals with us really weren't interested in us developing projects in these neighborhoods. They were either too small, they were too long-term, the profit margin wasn't going to be large enough in the short term, or they were just a neighborhood or area of the city that they weren't familiar with. So this really frustrated us, and we spent a lot of time thinking about what gets built and why things get built. And if you look at the two top examples, these are 2 projects in DC, but I think that you could probably imagine these projects being in pretty much any city in any part of the country. There's really nothing unique about them in any way. And if you look at the bottom 2 projects, these are examples of what we think is a trend that is really taking over. People want authenticity. People want something that feels like it's unique to the place that they're from. So you have what the consumer wants, and you have what's getting built, and there's a disconnect there. And so the more we thought about this, we really thought, okay, why is this? And the answer, as with most things in the world, is basically follow the money. If you look at where the money's coming from, it'll tell you why things are getting built the way they are. So this graph, which you can't see too clearly, basically shows the growth of institutional capital in real estate development. On the far left, you basically have starting in the late 80s, early 90s with the savings and loan crisis and the RTC. And the end of the graph is basically 09, 010. You can see the dip essentially in 08. But I mean, the graph is pretty straightforward. What it tells you is basically there's an exponential growth in institutional capital that came into real estate development since the early 90s. And a lot of the reason for that was the savings and loan crisis. What happened was that you had all of a sudden pools and pools of real estate assets. So whereas before that time period, most real estate was developed by entrepreneurs who were from the cities they were developing in, and they were raising capital from syndications or partners or friends and family who understood that area. All of a sudden you had these giant pools of real estate where real estate stopped becoming a local asset and it became a financial asset. Pools of real estate basically have to get bought by financial institutions, private equity funds, REITs, things like that. And what happened is essentially that the institutional real estate model has taken over development. And so what gets built is pretty much dependent upon who you're taking your money from. And if you understand anything about the way institutional capital works, it has short-term a mindset in terms of what it's looking for in profits. It's disconnected often from the places where you're developing. So when we're building in DC, rarely are we raising capital from anyone who's from DC. You're going to other cities, primarily New York City, and finding your capital sources there. So the people who you're investing with, or people who are investing with you, really don't understand the places that they're investing. Investment decisions are made almost entirely upon Excel sheets and pro formas, and really has very little to do with understanding the market itself, the place that's being developed, the people who live there, and what's going to be in the best interest of the community. So as we thought about that, we basically had a pretty straightforward idea, which was, what if you reconnected the investor directly with the projects or the property? It's not that novel in most areas of business today, but instead of basically going through a myriad of middlemen who essentially take fees for what arguably is supposed to be, their insight, or the fact that they are making your investment choices for you, what if we basically went directly to the people who lived in the communities where we were developing? So that's what we did. We actually took one of our properties public through a specific securities exemption, and we allowed anybody who lived in Washington, D.C. to invest in that project with us. We raised about $350,000 from 350 local residents. People could invest as little as $100 and actually be equity owners in that project with us. And what that allowed us to do was really focus on, again, building something that was unique to that community, that was in the interest of the people, and going out and finding support from the people who lived in that neighborhood. Again, the idea is going direct and cutting out, essentially middlemen who are really mainly there to pool money. It's really a supply chain problem at the end of the day. You used to have to go to someone who had a lot of money if you needed a lot of money, but with the internet and with the ability to basically share information instantaneously, the supply chain problem basically gets wiped out. And you can look in almost every other industry where you had a few central people who were making the decisions about what got created, what got printed, what got sold. Those industries are very slowly, actually some more quickly than others, are being disintermediated, and all of a sudden in news, in e-commerce, in fashion, whatever it is, it's actually the customer who is basically deciding what gets created from the bottom up, and they're going directly to the producers. So essentially that's the big idea. You can imagine what is possible when you start, again, going directly to the customer. By connecting yourself directly with the people who are in the community, who are from the neighborhood, all sorts of new things become possible. If you live down the street from a property you're investing in, you can go see it, you can touch it, you can go eat at that restaurant if you want to. The value that's created by that investment doesn't necessarily have to be purely financially driven. Maybe it was a vacant property before, and by investing in it and turning it into a new restaurant, the value of the neighborhood as a whole grows. A lot of times, again, you hear people talk about building what's in the best interest of the community. Things like a local bookstore or local coffee roaster or organic market have a hard time competing with, institutional tenants or businesses, because at the end of the day, they're going to be more profitable. But when you go back to the community and all of a sudden look to them as your investors, if you're interested in seeing a local coffee roaster and you want to invest in making that happen, Fundrise or a Fundrise type model basically creates that opportunity and makes it possible. So that's basically the idea.